All right. So the U.S. economy, we got retail sales this morning, much stronger than expected. The consumer is still spending strong. Well, we got the Chinese economic data, right, or China, whatever you want to call it. And China just cut rates, and we're gonna go over that data. But before we do that, let's take a look at the S&P 500, the proxy. The S&P 500 is basically a reflection of the stock market, right? The stock market's a lot of things, but SPY is an easy way to check out the overall market. What is the overall market doing? Okay, and we've been pointing out the support on the SPY at 444. It's pretty clear that the S&P is supporting the 444 level. I call this S1, right? I'm sorry, L1. No, S1. I'm sorry, S1. So support level one. S2 is going to be 438 ish, and then S3 is going to come down about 431. Right? So we're at S1. We have a lot of support to go. We talked about this yesterday. The 50-day, okay, the 50-day moving average is also a support here. So we got double support at this level. This was a previous resistance. And these are just the quick technicals showing you that this is a real line where investors are going to step in, or where the sellers kind of get out, right? Some of the sellers might get out. If we drop this support, we go to the next one. But so far, day after day, as we support this line, right, we hold the 444, 443 level. We might slip that today, right? There's a lot of confidence in the market. There are buyers coming in, and a lot of the sentiment is kind of, it's kind of negative. Some of it's positive, but it's definitely not clear what's going to happen next. It's definitely not clear what's going on next. So let's dive a little deeper. So the S&P is supporting the 444 level. Why? Well, actually, let's take a look at the dollar. The dollar, right, slowed down yesterday, came down this morning, and it looks like it's right back above 103, but it's at that trend. So we talked about this trend yesterday. It is at trend support, okay, or resistance, as you want to call it. So we're at the trend resistance there. Nothing happening so far in the dollar. We go over to the bond yields. Now, the retail sales data came out stronger than expected, and bonds quickly spiked. And remember, bonds are trying to guess what the Fed's doing. So if the Fed's going to tighten rates, bonds are going to move higher, right, to match that rate. And this morning, so far, they've reacted negative going forward, right? That's 2-year, this 5-year, the 10-year, on the other hand, spiked to like a 6-month high, and the 30-year. So longer term rates are making a big move higher. Longer term rates are making a move, and these are market rates, right? This is not the Fed funds rate. They're making a move higher. Okay, if you look at underlying bonds, they're starting to bottom where they did previously. Okay, bonds are bottoming. The VIX is not doing much, right? And we'll get to the rest of the credit market, see where things are headed. But for the most part, let's take a look at the data, right? The economic calendar. And what we got this morning is month over month retail sales. I just want to point this out, right? We came in at 0.7. It was expected to come at 0.4. So this is just the month on month reading. We've been positive for a while here in the U.S. economy for retail sales, and these are basically sales of sort of durable goods, right? If you're not familiar with retail, this is going to be autos. Look at general merchandise, food and services, drink places, gas stations, non-retail stores, building materials, garden. So this is just, retail sales reflect a lot of the purchasing that's happening in the economy, right? Not just goods, not just manufacturing, not just services, everything, pretty much everything. So consumers are buying, obviously with the strongest segments. Let's see, what were the strongest segments going forward? We had the strongest segments in general merchandise stores, okay, and food and beverage stores. So, hey, people are purchasing. So the month over month data is pretty positive. All right, now the year over year data, so this year over year is just looking 1 year back, came out much stronger than expected. We can see the chart. Let's put this on a line. You can see it's starting to bottom out here, right? 5 years, 1 year. Let's look at the 1 year. We bottom in April, and now retail sales, which were predicted to go, to keep falling, are starting to come up. Now, the reason why this is such a surprising report is because consensus was 1.5%, so 1.5%. We came in at 3.2, which is double the estimate. Double the estimate means that the economy, right, and the consumer side, we have jobs. The economy is recovering. The economy is stronger than people expected. The U.S. economy is definitely strong. Okay, it's not super like strong as in we're exploding, we're expanding, but we're not skyrocketing, but we're definitely more resilient given the Fed rate hikes, given how high interest rates. What are mortgage rates? Mortgage rates are at 7%, above 7. I think I saw 8% in some cases. Because those 30-year yields are up, right? Let's go to the 30-year. This really determines the 30-year. Let's go to the 30-year. Yeah, the more the 30-year bond yield moves up, the higher mortgage rates go up. So they're not one for one as far as percentage, but the movement of the 30-year yield is going to move the 30-year mortgage rate. So if you want to see our mortgage rates coming down, you want to go take a look at the 30-year yield, because that's how, lenders basically benchmark their rates. They benchmark their rates off the 30-year yield, if we're talking 30-year mortgage, right? Back to the to the economic data. So retail sales are stronger than expected. The economy is stronger than expected. There's no argument there. Let's go to the New York Empire State Manufacturing. This is a signal of the manufacturing activity. Now, this is surprising. We went negative. So more conflicting data. We were expected to come in at -1 and we came in at -19. So that's where we're in a rolling recession. There's areas of the market or of the economy that are still very weak. And this kind of keeps the Fed at pause. This keeps the Fed from getting too hawkish, from trying to crash the markets if they have to, right? So they want a strong consumer. They want, the Fed does want jobs to, one of their mandates is maximum employment, right? So we are getting maximum employment. We saw the unemployment rate a couple weeks ago or last month came in at 3.4%. But manufacturing, the New York Empire State Manufacturing Index, back to negative territory, okay? So it's tricky. It's confusing. Why is this economy, why do I hear things are strengthening and then weakening all of a sudden? Because it's a rolling recession, which basically means some areas are weak, some areas are strong. And this is really the perfect scenario to set up for the stock market to move higher, because if things are too strong, then the Fed will possibly keep raising rates if they're too strong, okay? But they're just strong enough to where there is no deflation, there is no economic collapse. So far, guess what? The data says there is no recession. That's basically what we're seeing. Now, the housing market index, so this is sentiment. These are home builder sentiment, finally fell for the first time in a while. We just haven't seen this happen. All right, and so what that means is that the home builders are, they're at 50. So like if we look at the historical chart, we kind of peaked out. Home builders sentiment or home builder confidence in the housing market peaked out. Now we're back in a very cooling environment for the housing market. We're back to cooling. And this is just looking at the data, right? We bottomed out in the housing market and now we're starting to cool a little bit. We're not skyrocketing up, and that's basically because rates just went up again. Long-term rates, as we just mentioned, went up again. So that's obviously going to deter demand for mortgages, and also it's going to push that demand. It's going to push that demand into rents. It's going to push that demand into not mortgage housing, but into rent housing, right? So the housing market as far as rents, and so you see supplier or construction builds for not single family homes, but multifamily homes is exploding. There's more supply of apartments happening in the US. So rents will fall, but housing prices are going to be pretty elevated. So again, like I said, you might have destruction in real estate, but you have rentals, you have rents coming down. And so there's a real demographic change in how people are going to behave going forward. They're going to still spend in services, but they might be renting until those rates really start to materially come down, right? Now, another part, right? So far the economy is expanding, the housing market is starting to cool. And let's take a look at this whole week, because the Chinese economy there's a big factor happening in the Chinese economy. And let's point that out here. So this was last night. The Chinese data doesn't come out till later at night. And usually this came out at 6:30 p.m. Well, my time, so in the evening time. And what we saw is that China cut rates. And we've been talking about this. We've been talking about China cut rates, right? China reliquefying their markets. So their rate was at 2.65%. Now it's at 2.5%. Now and this is in the last 3 months, they've been cutting rates. You can see they've been cutting rates. And my expectation is that the Chinese economy and we'll look at their economy, isn't bouncing back as strong as they would expect, right? They started stimulating back in October of last year. their economy recovered because they were in lockdown, and now, that recovery has pretty much peaked out. So I think they need to keep cutting rates to some degree, whether it's the 1 year rate, the 1 year borrowing rate, or the longer term rates. And their central bankers keep, central bank policy prints more money for the Chinese economy. So that's, I think, what we're going to see. This is basically Chinese industrial production. It came in at 3.7, was expected to come at 4.4%. So their industrial production, it's not like flatlining, right? They're not going into a deep recession at all. There's no, it's just flatlining. It's not as strong, right? It's kind of lackadaisical. It's not exploding. So the Chinese industrial production, which is a forward-looking indicator for, are you producing enough in your economy? It was weaker than expected. Chinese retail sales, right, came in at 2.5%. Expected to come in at 4.5. This was a big miss. So the U.S. consumer base is much stronger than the Chinese consumer base. Okay, that's the difference. This is not a competition. We're looking for global liquidity in terms of stock market. We want the global economy to start recovering with inflation falling. Now, keep in mind, this also contributes to Chinese inflation, which is negative. So China has no inflation, right? They have zero inflation, which is why they will keep printing money. They also had a youth unemployment rate that they removed from the data. It was so terrible. This is their regular unemployment rate. Their unemployment rate ticked up a little bit, right? As they're stimulating, as their economy is slowing down. It's not negative yet. You're going to hear in the headlines that China's economy is plunging back into recession. No, it is not. It is just slowing down, right? It's not accelerating the way others expected, given the central bankers and the government, basically handing out money to the markets, okay? But the Chinese youth unemployment rate, they removed it, okay? And I think I put this on Twitter. Let's see if we got this on Twitter a little bit. Oh, yeah, China cut rates. So they removed that the unemployment. So what does that tell you? That they don't really, their optics are very important, and what they don't want is for anybody to lose confidence in the Chinese economy, right? They don't want to lose confidence. Hold on, this is not what I wanted. Twitter, my computer's slowing down a little bit. Come on. All right. Now, the positive part here, and we're going to get to GDP, because the U.S. GDP, it's not just retail sales that are stronger than expected. U.S. GDP is now revised up again. So this is Japanese GDP. And the reason why I'm looking at it is because we've been signaling the global economy is recovering. The cycle is happening, right? There is no recession happening. The recession is nowhere to be found. Okay, there has to be a black swan event for that to actually happen. There needs to be a black swan event. And hey, that could happen at any time. Maybe it does. But let's stick with what we actually have here. And what we have here is the Japanese real GDP is climbing again. It is starting to climb. So the reason I point out China, Japan, the US, because these are the three largest economies in the world. And so we want to track that, because they're going to pull the load of the global economy. They're going to pull the load, right? How much they produce is going to matter. How much they consume is going to matter. It's going to affect the whole global economy. Now, this is today. This is the Atlanta Fed GDP Now estimates, basically estimates for gross domestic product or total spending in the U.S. Now, this is their estimate here in the green, and you can see they revised it up again, right? Now, keep in mind, about a month ago, okay, GDP estimates were at 1.4%. They came in at 2%, but now Atlanta GDP Now is estimating 4%, okay? That's insane, which means that in Q3, where everybody expects a collapsing growth, right? All the economists, all the headlines, watch out, here comes a recession. Well, part of the Fed, oh, I don't trust the Fed. Well, the Fed is actually revising up GDP forecast. So the economy is recovering, and I expect stock earnings to recover also, which is why I think this is just a buy the dip opportunity, right? The S&P is holding in here. Yes, maybe it is struggling a little bit from the past bull run, but we are holding that 444 level. Maybe we slip the 444 level, right? But it is not out of question that we don't bounce here at the 50-day moving average, where we've been bouncing, where we've showed support over the past, the past 6 months. We've had support here at this level, okay? So anyways, back to the data, back to the economic data. Another surprise, another thing that I was looking at earlier was, I think it was the economy for the other big economies which are going to be the, oh yeah, okay. So the inflation rate for the United Kingdom or for England, right? England's inflation rate, look at it dropped pretty sharply from 8.7 to 7.9%. Still pretty elevated, but you're getting progress on the inflation cycle. The inflation in England is starting to fall, okay? So European countries, we're looking at the inflation rate, keeping track of that. And this is progress, right? Looking globally, this is progress. And as that inflation rate drops, we're getting nearer to the global liquidity cycle starting to pick up. Okay, core inflation, all right? Core inflation did pick up and then it's starting to moderate a little bit for the United Kingdom. Doesn't look good. Core inflation doesn't look good. Looks like it's still climbing for them. But we are keeping our eye on this, on these different factors when it comes to inflation. Core producer prices, which lead inflation, are falling pretty sharply for the United Kingdom. Okay, and this is, I think they're the what? They might be, I think it's US, China, Japan, Germany, and then the UK and India, somewhere around there. So we're keeping track of the global economy. So we kind of know, where's the stock market headed? What can it feed off? They all affect each other, kind of like a domino effect, right? It's like a domino effect. So the global economies are different. China leads the global economy, and they're going to start stimulating again. So we're looking at S&P 500, and basically it's going to be trading off the rates, right? The dollar and rates. And after that retail sales number, that data, we expect GDP to forecast up. So I think that's going to put a bid in earnings for the stock market. I think earnings have pretty much bottomed. And if earnings have bottomed, then that is the biggest catalyst for stocks in general. Crypto, on the other hand, for crypto, it's going to take a different approach. Crypto needs these bond yields to come down. Crypto needs the Fed to cut rates. Okay, they need the Fed to at least stop hiking rates. It needs bond yields to come down to some degree, or right, despite a catalyst coming from regulation. If we just focus on regulation, well, if regulation improves for the U.S., crypto is gonna boom pretty soon here. Now, the biggest upside here. Okay, I'm gonna get your comments. I see some of your guys' comments. Let me make sure I didn't move it here. I know we got a couple comments here. After I said that, we're gonna get to oil because this is the golden pocket for me. Oil prices coming down, definitely the golden pocket. We need oil to come down. This is the biggest factor in my view, right? We keep talking about oil. It's getting rejected at the 83.50 level. So let's keep track of that. Hassan, what up? What up, Hassan? It seems that there's a lot of volatility in the market. It does, but if we look at the VIX really quick, like the VIX isn't really spiking. It is up today, but it's still below where it was the first week of August, right? We're in the second week of August. So the second half, we're leaving the second half of August, right? The data for August. And the VIX is still below that, right? Even the Nasdaq VIX, right? Or tech volatility is going nowhere. Bond volatility, right, is still below that level. So I'm not really seeing too much volatility right now. I think this is a buying opportunity. Okay, obviously your time horizon's gonna matter the most, right? What is your time horizon? If you're looking over the next week, well, we're not predicting that. We're just looking at, is the overall market trend still moving up? Wait for that August CPI. Yes, the August CPI is going to be important. If we get two consecutive, so we just had one inflation print higher on headline. Remember here, Mr. Momo 74112, core inflation, which the Fed really targets, right, really keeps our eye on, dropped. I don't expect core inflation to go up. There's no reason for core inflation to grind higher. Core inflation is now falling while headline actually ticked up. So core is in a good spot, right? Not now. It's still elevated. Don't get me wrong, but it's falling, okay? Where headline, maybe what you're talking about, the August CPI, that's going to be very important. The August CPI next month. And it's really about oil prices. So if you're taking a look at, what is CPI going to look like for August, which is next month, right now, oil falling, that CPI is going to look good. I think we get to, if this continues, if we get crude, so the focus is on crude. If we get crude continually falling here and rates peaking out, how funny is it, right? Crude falls and rates peak out. So you would expect, okay, some of you bond market guys, you would expect retail sales are hot. Shouldn't rates be climbing higher, right? Shouldn't the 2-year rates are climbing higher? No. Why is that the case? Because I think the bond market is actually responding to oil prices, which are a bigger factor here, not retail sales, because inflation is the biggest dragon here still for the market. And that's going to come from oil. We know that. That's the only reason CPI even ticked up. CPI only ticked up because oil went up 20%, basically, right? And now that oil is getting rejected, we see rates actually fall. We talked about this yesterday. I think rates are trying to front run the data. And if the data doesn't come out bad, then rates come down and they start to ease a little bit, okay? And when I say rates, we're not talking about the Fed funds rate here. We're talking about the bond market, which is the equity market rates. This is the real interest rates for the global financial system. It's all about bonds, not really the Fed funds rate. The Fed funds rate, has an effect, but this rate moves on a daily basis, okay? So what is the point here? Bonds are responding not to retail sales data, which came out stronger than expected. They're responding to crude oil coming down. They could be responding to weak China also, but hey, this is the US bond market, not the Chinese bond market. Okay, so I just want to say that real quick for when I think so far, again, like I said, if oil keeps coming down, the CPI for August, I'm very optimistic about that. I think CPI continues to make progress. Bro, we had a fun ride up on Tesla last month, but I've been making so much shorting it since 300. Okay. Yeah, shorting since 291-ish, I think, right? We got up to about 291-ish on Tesla. It was the buy the earnings. Now it's coming down 100%. I should have sold some calls up there at 291. I missed that train. Did miss shorting Tesla. But now I'm looking at this. We're actually going to do some Tesla technicals if you guys stay in here. Once we finish this segment on kind of, what's going on in the macro, the economy, then we're going to jump into Tesla technical analysis. I want to take a look at Tesla. I still think it's the best. It's going to be one of the best options moves. And if you're an investor, Tesla's almost an oversold territory. I like the technicals for Tesla. Maybe there's some other, what up, Ace? How you doing? Maybe there's some other technical setups that are pretty well, but the Tesla catalysts, I think, are going to be good, especially because what is China doing? China is cutting their 1-year rates. That is going to boost or actually lower prices for the Model Y, right? And I think Chinese demand picks up. So that is positive for Tesla because it's a multinational, multinational equity or a multinational company. And if China's cutting rates, right, then, that's a bid on Tesla demand, right? Maybe it doesn't come out exactly that way, but that's what we anticipate, right? Cheaper money, cheaper borrowing costs, more demand for the Tesla Model Y and whatever vehicles that they're coming out with, okay? Is it time to short oil? If you're going to short oil, you better short it against 83.50. That is the big level, right? That is the big level that we will continue to speak about. 83.50 is the monster level for oil. Also, okay, when it comes to oil, okay, let me answer you guys' questions. What were we talking about? Just keep this in mind also. OPEC has been cutting production or supply. So this oil run isn't demand. It is not demand coming back into the market. What it is it's a supply cut. Okay. So I think the real bull move in oil already happened. I think this was the bull move in oil up to 83.50. You need demand to come in also. And we see Chinese manufacturing is weak. US manufacturing is still weak. Global manufacturing is still weak. ISM PMIs are still weak. So there's not going to be no material move in demand for oil prices. We're actually headed into a seasonally weak period for oil. Right? The summertime is over pretty much. And so I think oil, you're going to have to cut more supply. So, hey, if we get some more supply cuts, maybe oil goes up. But at the same time, the U.S. is actually increasing their supply. Nigeria is increasing their supply. Iran is increasing supply. So you have an increase in supply dynamics while others are cutting. And I think it just nets out to nothing, right? And as the traders step in, the traders are going to say, all right, that move is over, right? We need another catalyst to get oil demand up. And so until we get another catalyst, I'm pretty bearish on oil at this point. Is it time to short? Well, if so, make sure your stop is at least above 83.50, maybe even 85. And maybe you want to see a retest also. You want to see a retest up to 83.50 and then start to roll over. Then you can short oil there. In my view, that's what I would do if I was going to short oil here, Hassan. All right. So yeah, Tesla getting crushed. Let me see. Do we have any other macro stuff going on here? Oh, just keep an eye here. This is the money supply growth. So what I think is going to happen going forward, now that China cut their 1-year rate, I think they're going to keep cutting. I think they need to keep stimulating to keep their growth from completely collapsing. Okay. And if that is the case for China, let's just go to their home price index. See what is their home prices are starting to rebound a little bit. They're pretty negative still. So the Chinese economy, I want to go to their GDP really quick. Annual growth rate. See. So their growth is still picking up, right? China's not falling apart. People are saying that, but their GDP is still, is still up. It's just not recovering as fast is people expected. So where's the GDP growth rate? Not that one, not the annual. I want to see this one. Okay, so this is the quarter over quarter growth rate for China in their GDP. In order for this to get back up, to really start to, to make its way higher, we're going to need China to keep stimulating to either, and that can come through three ways: government policy, so government spending, the way we're seeing Biden. He just sent out $700 per household for the fires in Hawaii, right? Well, that's kind of stimulus. You don't want to call it pure liquidity, but that's stimulus. I expect him to keep doing it to get his rating up, right? So Biden will keep stimulating. Well, who knows what's going on in China? China may keep stimulating their economy, or they cut rates. That's another way to increase liquidity materially, right? Or their central banks start printing, and we can look at their central banks and see what they're doing here. Let's go to the money. China 1-year MLF rate. So this is their rate, right? They're cutting the rates. If you want to look at this website, it's pretty simple. 2.5%. They just cut, and they've been cutting for a while. So they've cut this is the second time they've cut, and since they've cut a couple times. So China is cutting rates. M2 money supply. How's their money supply? It kind of slowed down in July, right? So their money supply did slow down in July, but their money supply is still picking up. And the reason I'm focused on the Chinese economy, because they are the leader of the global economic cycle. China usually leads that, just like it did in 2002 when they basically started, stimulating like crazy, and you had a lot of commodity growth. Oh, we didn't even look at commodities. Commodities are not going up. So everybody, with this inflation coming back up, commodities are going nowhere. Copper and oil is getting rejected at 83.50. Copper is actually rolling over, and we'll get to that. Okay, I got a lot of stuff in my head popping up here, but copper is Let's look at their central bank, okay? China's central bank, what did we just say? April, May, June, printing, okay? Chinese central bank. So this is important. Global liquidity, I'm expecting their central bank balance sheet to keep climbing. They are printing, okay? And this was, okay, it doesn't tell me when they printed this, but expect expect China to keep printing money, to keep cutting rates, to keep injecting liquidity into the system, into the global economic system, as a proxy to push up crypto, as a proxy to pick up U.S. equities. Okay, they're going to benefit from that. Not just a one for one. Oh, they cut rates, everything goes up. No, but over the long haul, the more liquidity, the more growth that comes, the full economic cycle will pick up, and we should see that happen. Okay. Now, what about their loan growth? I want to see let's see their loan growth, Chinese loan growth. Let's see their 5-year. Have they cut? They haven't. Oh, they did cut their 5-year. It's at 4.2%. This is their 5-year rate. So I'm going to keep looking at China, right? Expect the 5-year rate to possibly get cut. I don't know, maybe not, but we got to keep our eye on China cutting rates. That's also a leading indicator to our central bank. I'm starting to believe now that the US Fed, right? Jerome Powell will cut rates in 2023. Right? If inflation gets low enough, he'll cut rates. He mentioned, a lot of people forget this, he mentioned that the US will cut rates before we get to 2%. Okay, but we just hit 3%. Okay, we had a little bump after 12 months of decline. We had the longest decline in CPI in history, in recorded history, the longest decline, and you get one bump and all of a sudden you're rooting for a reflation period? No, that doesn't make any sense. Of course you're going to bump up a little bit. Inflation trickles down. This is just the bounce up a little bit. Now, if we get 2 more consecutive climbs, then maybe we can say, okay, maybe inflation is going to come back up. Where are the 2 bumps going to come from? Oil prices. Bro, just keep your eye on oil prices. If oil doesn't go up, you're not going to get a reflation in inflation. It's not going to reflate, okay? All right, so loan growth for China, it has been trickling lower, so the loan growth is down a little bit. But what about these reverse repo? Oh, yeah, they just had a big reverse repo liquidity injection. So basically, the Chinese reverse repo facility is injecting liquidity. Let's just put it that way. There's a lot of ways to look at it. China is injecting liquidity, and this is gonna lead equities higher. This is gonna get us that bounce, right? for equities. It doesn't mean that they're buying US equities, but the global financial system is connected, and Europe is still fighting inflation. China is not. We are still fighting inflation. China is not. China leads, and China is leading the economy, and we're next. So I think by 2023, we're going to actually see the benefits, or I'm sorry, we're going to cut rates if we get oil to keep falling. Okay. India also is one of those big economies. We've got to keep our eye on India. And I think India their demand for oil is falling right now. They're doing some maintenance on their energy production. I don't even know how that stuff works. I'm just listening to a couple things. Maybe I'm wrong. I'm just reporting what I've heard, right? And we just know the big level is 83.50. And then so far, we're not violating. We're not holding above that level. So the risks are not there. The dollar is getting rejected at the trend. So maybe we go lower from here, okay? Asan, can you cover BTC, ETH, and crypto in general? Yes, we will. Yes, I'll cover that for sure, 100%. We'll go over that. Just want to make sure there's nothing else here that we are missing. Yeah, so the Chinese economy will keep stimulating. Look out for more either rate cuts or China injecting more liquidity into the system. Look out for that. Another thing I wanted to touch up on is this whole idea that rates are so elevated, the stock market's gonna struggle here. Yes, it's gonna struggle. Obviously, risk assets, which includes equities, are gonna do better when rates are falling, when the bond yields are falling. But historically, right, if we do look historically, let's go to SPX historically. People forget in 2002, okay, let's go to the month here, the monthly chart. In 2002, right, rates were at the same level. 10-year rates were at the same level, not 10-year rates, but oh, man, that was way back in the day. Actually, we could actually go back there too. Let's see what the rates look like back there. Okay, so we'll go to both places. Anyways, what I'm looking at here, what I'm trying to point out here is that this is the 10-year bond yields, right? These are rates that are tightening the market. When these things increase, you don't really want this because it pushes down valuations for stocks. Okay, it does push down stock valuations. Now, in 2002, so this was 2002. This was after the dot-com bubble. We bottomed, kind of like we are now. We bottomed. We started to incline. Now, as the market, chugged higher, as the market recovered, so did rates. Rates went from 3.4% here on your left, right? These are the rates, 3.4% all the way up to 5. This is the 10-year yield. It went up to 5. That's what we're seeing right now. We're at right now the 10-year is, what is the 10-year at? The 10-year is at 4.2. And guess what? The market grinded higher. So it's not, it's not like crazy that rates go up and the market goes up too, right? I think we can still go higher with these rates up at this level. We can still grind higher given that fiscal policy continues, given that the earnings is starting to recover, also that GDP is starting to revise up. So you need other catalysts for that to happen. It would be great if the dollar rolls over, but it can happen. So rates alone are not going to crush the market, okay? Rates alone are not going to crush the market. And if we go back, let me see, if we go back, oh, okay, this is tricky. How are we going to do this chart? Let's just pull this down. If we go back to the 80s, it's sort of the same thing. If we go back to the 80s and we see where rates were at, what, 4 or 5%, did the stock market move up? Let's see. So here we got rates at, so we're at 4.2% right now. Let's look at the 4.2. 4.2 is right here. So 4.2% market dipped right here. Man, this is really hard to zoom in on this. But basically, you had 4.2% rates here, and they did climb higher, and the market did decline. And so that wasn't a good example. But in 67, rates went up again. So bond yields went up again, and the market recovered. I think it's just hit or miss. It's a lot of things going on there. And the market recovered a lot with higher rates. This was before the big change in the 80s, though. This is before we really started, devaluing the dollar and buying back bonds. So this was the change of the highest rates in history. Now we have so much debt, you can't really get rates that high. It's going to crush everything. So we have too much debt for that to happen. Anyways, the whole point there is back in 2002, when, we had the big bull run in 2002, this was the bull run in 2002, you did have 10-year yields climbing from, 3.4 all the way up to 5.2. Right now, we've climbed from 3.2, we're up to, we're up to 4.2%. Okay, now it's not going to be good if we keep going up, but the point is the market can still recover. If we have a financial, now the risks here are that the banks, because you're seeing that Moody's might be downgrading JP Morgan, that's a big risk. And it's all because the collateral is dropping. So just to keep in mind here again, right, as these bond yields go higher, which you're actually seeing as the bond yields go higher, right? This is the 10-year bond yields. Banks have to buy these yields. They have to buy these bonds, right? And what this really is an example of is, let's invert this, is invert the scale, is that the collateral, this is the collateral is actually falling. This is why there's downgrades on banks right now. This is why regional banks are struggling, because since 2020, right, the value of their collateral, they use US Treasuries as the collateral. They are the benchmark to all collateral in the system. That collateral is falling. So if it continues to fall, then, you know, they're borrowing. They really, it's kind of like the banking crisis in March. If that collateral keeps falling, they're going to be in trouble, right? But everybody can see this issue. It's not, you know, it's not like we're blind to it. We know the risks, which is why I expect the US Treasury or the Fed to step back in. We expect the balance sheet to pick up again at some point as things continue to slow. So keep your eye on for that. Or the Fed just cuts rates, right? The Fed cuts rates earlier than expected to get those bond yields to stop climbing, because if the bond yields keep climbing, then if the bond yields keep climbing, then you basically get, you know, banking risks. Okay, I know that was complicated, but I just wanted to push it out there. Let's go ahead and invert this back up, right? So there's a lot of issues. The bond market is very important to keep your eye on. Maybe I didn't simplify it the most, but just keep in mind this, or think about this. As rates climb, right, obviously borrowing costs go up, and at the same time, the collateral for the banking system goes down. So the collateral is falling, and we cannot do that. There's too much debt in the system. That's going to cause a black swan event. Okay, I don't even think it's black swan, because we know, obviously, you know, the higher rates go, the more stress is going to be on the banks. So that's something we got to watch out for, 100%. What is your source for this information? Oh, Tesla, please. Okay, yeah, we'll do Tesla right after this. Let's just go jump into Tesla. I'm actually gonna throw on. We'll stick on this chart. What is my source for this information? You can go to not China Central Bank. You can go to tradingeconomics.com, and there's if you're on YouTube, so I'm showing this on YouTube. You can go to the calendar and just look at Indian inflation actually jumped. We talked about this. That was bad. You can see the calendar, all the economic calendar data. I'm just interpreting the data. So I'm giving you my opinion, how I see it, what I think is going to happen. And we've been talking about China re-stimulating liquidity. And guess what? We just got that last night. China finally cutting rates. Okay. And I think they're going to keep doing it. That is my conviction, that China keeps cutting rates to get their manufacturing economy and their service economy back up. They also removed the youth unemployment rate because it's so bad. So China will keep stimulating, and they're going to have to sacrifice their currency. They have to devalue the yuan, which kind of sucks for them. They don't want to do that, but they're going to have to do it, or else the economy, you know, falls apart. So my source is, I mean, there's a lot of sources. You can go to the YouTube, go to the website. I write about this every single week. Follow the newsletter, check out the newsletter. Basically all that information is there. I grab information from Twitter, other economists, other traders, whatever it is. And we just try to combine all the information to give you the best outlook on the market. All right, so yeah, let's dive into Tesla. So what are we at? We are at 38 minutes and 50 seconds. We are going to jump into Tesla technicals. Okay, everybody wants to hear about Tesla technicals. All right, now let's start here. Let's see, this is, actually, no, I'm going to switch charts. I'm going to go to the TOS charts because I like those better. Those are better for trading or technical analysis in general. So let's switch those charts, and then we'll go over BTC, ETH, and crypto right after Tesla. Let's do those two things. If you guys have any other questions, we will jump into that. So first, let's cover Tesla. Let me widen this out. So it looks a little better on YouTube. Yeah, let's widen this out. Okay, so here's Tesla. We don't really need the volume right now until there's actually a breakout. But what I do want to focus on is, let's see. What I do want to focus on for Tesla is the RSI. Okay. I love the RSI. I like to use the RSI. And historically, when the RSI gets oversold, I called this a lot. I mean, not that I called it, but everybody's watching the RSI. When you get extremely oversold, Tesla's a name that trades a lot of options. A lot of people want to take that trade. They want to capitalize on the technicals. And we're close to oversold. Last time we got oversold was January, February, March, April 26th. That was pretty much the bottom. Okay. That was the bottom for Tesla. And Tesla went up from that point. It went up, what is this? About 2 months later, 2.5 months later, it's up 100%, right? It's up 100%, basically 100%, 90%, whatever you want to call it. So we're near that oversold territory, right? Now, the last time, even before that, if we go before that, it got extremely oversold, but the overall market was weak. This was in January. The Tesla went from 100 to about 220, so it went up 100. So the last two times, just say this, the last two times we were oversold in Tesla, it went up somewhere between 80 to 100%. And we're near the oversold territory. It's actually dropping support. It filled the gap and it's very weak. So I'm looking for one more capitulation. Yesterday we said, hey, if Tesla gets, if Tesla could retest the trend and then get rejected, but now I think this is it. I think we're going to get that sharp drop. It could gap down. What do we got? We got about an hour left in the market. An hour, 12:30, about hour, 30 minutes. I don't know what it is. I'm not looking at the market. We have so much time left in the market. So if we slip lower, maybe we get that gap down, and in the morning, that's the bottom. Okay, that is the bottom in the morning. Looking at the Qs, looking at the SPYs, they are holding up. But the point here is, RSI is near oversold down here, right? Once you get the oversold signal, to me, that is the time to buy Tesla. Okay, that is the time to get into Tesla. I'm not saying go do it, right? Do your due diligence, understand why you're doing it, where's your stop at, whatever. But that's the best risk reward, is that a very oversold technical chart is going to offer you the best risk reward if the market keeps grinding up, which I expect it to, because GDP is revised higher, because inflation's coming down, because the Fed is close to pausing maybe in the next cycle. So you're looking 6 to 12 months out and saying, hey, Tesla will be much higher from here, especially if we get that oversold. Okay, signal. All right, now let's get a little closer in. Let's go to the 4-hour chart. Okay, and I'm actually going to switch this to the macro because I think we might be testing some moving averages also. Okay, so we're number one, RSI is nearing oversold territory. That's most important. Number two, we are holding the trend. So this is the trend, the uptrend from the lows that were put in January, right at $100. We're testing that trend again. So we've already had support at that trend. Now a trend is only a trend. This is not 3 points on the trend. This is really only one. This would be two. Make it two supports at this trend. Okay. A trend is you can only draw a trend if there's 2 points that are touching. So we have this is not a touch. This is the beginning of the trend. We had the first touch in April, right? We had the first touch in April. We had the second touch of the trend in May. Okay, then we exploded. We had that big upside move. I remember we all traded this back on TikTok when I was trading on TikTok. All right, we traded that. Now we're slowing down and we're coming into that trend again. So number one, the RSI is oversold. Number two, we're pulling into the macro uptrend. Number three, and this is the daily chart. Okay, so number three, I guess you could say number three, we're in a very sharp a pattern here. This is a descending wedge pattern, right? This is a falling wedge pattern. This is a very sharp pattern for Tesla. When it breaks this, it's going to move sharply to the upside. That's what it typically does. So I like this pattern because it's been in this pattern since earnings. So we already have a month in. We're about a month in, just decelerating, just forming that sharp pattern right into support, right into the trend as RSI is oversold. So expect Tesla to capitulate. Maybe it comes into that. Maybe it comes down to 220. I don't know. I'm looking at 235 though. I want to see the support at 235. There is another gap. I didn't see this. There's another gap here. Let me kind of zoom in. There's a gap to fill at 234.80. No, we filled that gap. What am I saying? We filled that gap. That's not the gap I'm looking at, is it? Oh, no. Here it is. There's another gap here. Let me draw this gap for you guys if you're on YouTube because, these are that's a sharp move, 221. So you got a gap at 221 for Tesla also that could be filled. Keep your eye on that gap. It's right here. Let me zone into it. So the price just basically gapped up at 221, right? So maybe you come down to 221. If we do, then we're going to be extremely oversold. And that's also going to be a level. If you're looking 6 months out, if you're looking 12 months out, that's going to be a nice level. Even 3 months out, possibly. But I'd like to keep it a little more safe and keep your time horizon a little further out. Okay. So we could be gapping down into that 221. So now I'm looking at 235 and 221 or 222, whatever, however you want to, look at it. We're in trend support. Now let's take a look at the weekly chart. I want to see if we're moving into any supports on the weekly chart. Not really. We dropped the 100 moving average in blue. The 50 doesn't look great. It's pointing down. So we need a bounce. We do need a sharp bounce. We're not seeing it there. But the 200 is still pointing up, right? So the longer term trend is still pointing higher. That's a positive. That's good. Let's move to the 4-hour chart. Let's see what it looks like on the 4-hour chart here. Oh man, it looks nasty. It's below all the moving averages. You get a death cross. So you need buyers to step in. You're not really getting a whole lot of technical support here. This is a very extremely oversold. And hey, don't forget, we bounced last time we got away from that 50-day sharply. We bounced here. This was also oversold and we bounced, right? Back here, same thing. We got extremely oversold beneath the 50-day moving average and we bounced. So maybe we do get a sharp pull into 221. Maybe we do get that. It's going to be a nasty move. But hey, Tesla, a lot of people believe Tesla's at all-time highs by the end of the year, including myself. When it moves, right? We're still in the uptrend. Take a step back. Take a step back. It has a lot of catalysts. Cybertruck. You got Cybertruck coming at the end of the year. You have, if you have the recovery in margins that are happening now. You have Chinese liquidity. You have the inflation is falling. So as long as inflation falls and producer prices fall, then their prices are going to be cheaper to produce a car. That's going to increase their margins to some degree. So this is the trend. Look, we're just pulling into the trend, right? Boom, boom, boom. So I think Tesla looks solid. I'm looking at the support somewhere between 235 and 225. I'm sorry, 221 is the area where I think it should bounce at. But still, keep your eye on that RSI. Keep your eye on that daily RSI. And I think that's what we're looking at when it comes to Tesla. Any questions on Tesla? Excuse me. What up, Soggy? 226. What up, Carbides? We got some dudes in the chat. Tesla, please. What is your information? Read that. 226.15 is a 50% of the on-pulse move up from 152. So Tesla's getting really close to my buy area. Okay, so Carbides, really good trader. TikTok trader, go check him out. He says 225 is a good, somewhere between 221 and 235. Right, we just got to keep up with the technicals, and we got to keep our eye on the overall market. Right, S&P, like I said, another signal here is going to be watching the S&P. Okay, watching the S&P. We know where the zones are. We've been looking at these zones for a while, so we're keeping our eye. Let's go to the daily chart for the S&P. S&P is also going to be that signal. Tesla may just support the 235 level. So here's what I'll say, and I'm pretty confident. I'm 90% confident. If the S&P does not move under 444, if it holds this zone, this previous resistance, if it holds that zone, the 50-day moving average also, and it moves up and it breaks out, and that's the bottom for the S&P, right? And we have a lot of data that could suggest that, could support that, right? Yields are peaking, oil's coming down. If that's the case, earnings are doing pretty well so far, then I don't think Tesla drops below to 226 or 220. It could still happen, but I think Tesla is more realistic that it's going to bottom at 235-ish, 234, and I think we're seeing that today, right? But if the S&P drops the 50-day moving average and comes back down to the next, 438, then Tesla probably goes to 226, 225, right? If the S&P drops all the way down to 431, then I think Tesla buyers definitely come in at 221. It'll be extremely oversold. It's going to look like a good deal. The PE is obviously going to be better because price is down while earnings are still climbing. So I don't think Tesla goes any lower than 221. So 221 to 235 is that zone I'm looking at here. Watch the S&P to see, watch the S&P zones to keep track of that. The macro is all about oil. Can oil stick where it's at? Will the Fed signal a pause in this next signal pause? I think it can. The only thing keeping up CPI is shelter. It's shelter inflation. And shelter inflation is really non-existent if you consider the lags. Okay, it's really non-existent. So we'll keep our eye on that too. Also, the Qs are obviously Tesla has a bigger is a bigger factor in the Qs. So we also got to keep our eye on the Qs, but the Qs have been declining for a while here. Very sharp descending channel. I like that. I like the sharper we get, the more we descend, the closer we get to the bounce for the Qs. The closer you get for a bounce in asset prices, right, on a technical basis. So we are pulling back pretty sharply. I expect that bounce to come in at some point. All right, if we have no more Tesla questions, we're going to move over to Bitcoin and ETH, right? We're going to look at the crypto market. What are altcoins looking like? What is Ethereum looking like? What else do we got here? What up, Soggy? How you guys doing? Big man's coming. Shout out. Got a new job, so I haven't been trading much. Been in my adjustment period, but I'll be back soon. Cool. Sounds good, Soggy. I mean, hey, there's nothing like just holding a good asset over the next 6 months. You have fixed income. You're in a good spot. Just let the market do the work for you, right? Less trading if you don't need to. SPY bouncing off the 50 MA on daily, so everyone is watching that too. 100%, exactly. We just went over that. All right, so let's take a look at crypto. I'm going to switch charts. We're going to go to the other charts that are a little more flexible. There's not really a lot of crypto on the TOS, so let's flip over to that. Crypto just needs regulation. Okay, crypto really just needs regulation. So yeah, let me adjust my seat a little bit. We're at 51. Oh man, I hate sitting down. I'll be back in my office maybe at the end of this week. I don't know, I might stay a little longer. All right, so let's start with the total crypto market, okay? Total crypto market. Do we want volume? Not really. We want the moving averages. Yes. Let's take off the 10-year. We don't need to look at the 10-year. So the total crypto market, and you always want to use a log chart, by the way. Always use a log chart when it comes to crypto. If you're on the daily charts, right, you need to use the log chart. That's going to be a little more accurate. So this is it. Let's start with the weekly chart here. So crypto's struggling, right, to get over this area, but this is definitely a lot of consolidation. We've been consolidating here for a while. We haven't dropped anywhere. A lot of tightness. I mean, the ETF and regulation. It's just like, how do you not front run that? A lot of people are going to front run crypto. They want to see it get above 32K or 1.25 trillion when it comes to the overall crypto market. They want to see that happen, and that's going to come. We could see this with the Chinese liquidity, right? If China keeps stimulating, cutting rates, re-accelerating the balance sheet, then you could get a bid. You can definitely get a bid here. So the overall crypto market, it looks just like Bitcoin. Okay, now total 3. This is excluding Bitcoin. So if you take out Bitcoin and Ethereum, this is altcoins, right? Altcoins are basically consolidating also. Maybe they get a little weaker, who knows? But altcoins are explosive, obviously. They're not trending higher, they're trending sideways. So the longer the consolidation, the bigger the breakout when it does happen, right? Bitcoin dominance, really quick, because a lot of Bitcoin dominance is going to depend on, or a lot of the altcoins are going to depend on Bitcoin dominance. Bitcoin dominance is still climbing. If rates keep going up, I expect Bitcoin dominance to pick up. Altcoins might get crushed. They might get crushed here unless we get more liquidity into the market, either from China, from Japan, from the US, cutting rates, whatever it is, who knows. But altcoins are obviously more of a risk asset, more riskier asset. So they're gonna be sensitive to bond yields, okay? All right, Bitcoin. So let's just take a look at Bitcoin here. Man, it's just consolidating. It's right on trend. It looks like Tesla, right? It's just right on trend. It's a little boring, but that's what you want. You want a boring market. Let's go to the daily chart, see if it's holding any levels. It's all about regulation. Right now, Bitcoin is boring until it's not, right? It's just boring until it's not. It needs another catalyst. The real catalyst, other than regulation, other than the ETF, is going to be rates coming back down. It's going to be Powell saying, all right, we're going to wait and see. We're not going to hike here. Inflation comes back down. I still think the biggest catalyst is oil dumps back to the 70s. CPI is going to come down to 2.7, maybe even 2.5. CPI can come down to, and the Fed will now start prepping to cut rates. That's what I think even this year. Even if they cut it by 25 basis points, they're already in restrictive territory. And if they keep rates high the way they are while CPI comes down, then you risk losing the soft landing. They're not gonna lose the soft landing. They want inflation down, so if they see progress, we get closer to a soft landing. Okay, it's just as simple as that. So it's all about oil prices in my view. I say that every single day. It's all about oil prices. Most important chart. That's what started everything in the first place when Russia invaded Ukraine. Oil spiked, and you really had inflation exacerbate because the supply chains basically were broken. So Bitcoin is just grinding higher. Is there any other news in the Bitcoin market, in the crypto market? I mean, obviously we can take a look at that. It's just the same stuff. Everybody's waiting for regulation, nothing too important. The technicals are the technicals, right? Looking at ETH, let's take a look at Ethereum here. ETH, same thing. ETH, same thing. It's in that uptrend. As a matter of fact, I can keep the uptrend here because it's just an uptrend. But maybe I'll draw a little wedge here. We also have a wedge. I see a little wedge happening in ETH. But I don't think there's much happening with crypto other than you need regulation or lower rates. That's all I'd say. You need regulation or you need lower rates to happen. Other than that, we're just waiting for, this consolidation to break out. There's a lot of anticipation here. I know some people are calling for a retracement. Maybe ETH does come back to 1600. I could see that happening because then you would form like a descending triangle. Okay, you'd form a descending triangle, and here's that descending triangle. If it does come back into 1600, you're getting the descending triangle, right, out of the trend. So now it's like, okay, the risks are to the downside. So you get that descending triangle, but it's just going to come down to regulation and rates. So crypto is boring right now. Okay, crypto is boring. You're just waiting for that big macro move to happen. ETH to BTC still elevated. Everybody expected this to get crushed. I think this just is a testament to Ethereum being very resilient versus Bitcoin. I think it does. There's a lot of Ethereum ETFs being filed right now in the US and Canada and other areas. So if that ETF comes out for Ethereum, then I do expect ETH to BTC to start to outperform, right? Ethereum to start gaining market share against Bitcoin. And that's going to be a monster trade. I think this is the easiest monster trade other than Bitcoin in the market. It's Ethereum. It's going nowhere. It's improving every single day. It's the most dominant blockchain Web3 platform by far. Okay. Now, if you're worried about commodities inflation, I know a lot of people are saying there's a commodity inflation coming here. Look at copper. Copper just broke down. Okay, copper is, well, not like completely, but copper is coming down. I think this may be the traders, not necessarily demand, maybe demand too, but I think the traders are saying, oh shoot, China's weaker than we thought. We better just collect our profits now before and wait for the economy to start to pick up again. So copper is selling off. Copper is selling off. Maybe it needs to go back down to the RSI, and we already know oil's weak. Right, natural gas is still struggling down there. I know everybody's bullish on natural gas, but we're headed into, maybe natural gas doesn't catch a bid until we head into the winter months or get close to it. So maybe October. Okay, I can see this going up in October. Okay, that could be the case in October, but for now, commodities are pretty low. No commodity inflation. I think the biggest disconnect when it comes to my expectation versus a lot of other economists is that inflation is not coming back. I think we're headed actually for deflation. Look at China, man. They're negative inflation, negative PPI. I think we're actually headed for deflation. That's like even scarier because your debt is at risk at that point. So maybe we cut rates August, September, November, maybe October. I'm really looking at October saying maybe there's a chance the Fed cuts rates in October if oil remains under 83.50. I think that's a big chance there. I think they can definitely pause at this next meeting, no doubt. But cutting rates could follow right after that. Remember, Powell said in his press conference, he said, somebody asked him, will you cut rates at 2%? And he said, no, we'll cut before we hit 2%. As a matter of fact, he said, we will pause before 2% and then we'll cut before 2%. So we're almost there. We just need oil to come back down, right? What else do we got here? How do I go live? I mean, just Google it. Just YouTube, how to go live. Just use your resources. Uh, Random highest. Oh, would you accept before you? Um, that's a funny question. Shoot, maybe like 5, bro. Maybe like 5. Yeah, maybe like 5. There's other factors to it, but yeah. Okay. So getting back to the market, let's jump into the internals. I think the market has what, an hour left of trading. Let's see what's going on there. And we'll go over kind of what's going on with the, let's see. Oh, and CNBC. Yeah, what's going on with CNBC. I also want to play a clip that I edited yesterday if you guys want to check it out. Just a couple talking heads on what they're seeing for the market. Some people are saying that the mega cap companies need to bounce here. I think they do. I think we do need to see the Qs bounce. We're still getting rejected by that 50-day SMA and the Qs, but I think it's very realistic that the Qs pull back into 358, 357. I think that's where the buyers are at for the Qs, 357. Look, the RSI is coming down there to that exact spot also. So 357 possibly. Can you give a basic idea how the economy works? Yes. So basically, for the economy is driven by total spending, right? Whether that spending is from government, consumers, or what do you have? Government, consumers, or corporations. So the total spending of all corporations, consumers, and government equals your economy, or equals the growth of your economy. Okay, that's the basic premise there. Total spending runs the economy. What are the influences of that spending? Well, the influences are going to be the debt creation from the Federal Reserve or the government, right? The U.S. Treasury, they create U.S. Treasuries. They're called U.S. Treasury bonds, and they sell those bonds. And when they sell those bonds, they collect cash. And what they do with that cash is they spend it into the economy. So how much they're borrowing or how much bonds creation they create is going to also impact the economy. The Federal Reserve, how higher interest rates for the market. There's a lot of interest rates. This is confusing, but there's a lot of different interest rates. And the Fed controls one interest rate. It's a 24-hour rate called the Fed funds rate. They control that, okay? If that interest rate is higher, then the cost of capital for banks to borrow overnight is higher. Therefore, you constrict liquidity in the banking sector, who really lends out money to corporations. So put it this way: if banks have to pay more to borrow money, they're going to charge you more to lend you money. So that's why that Fed funds rate is so important. That affects the economy also. Okay, so the economy, runs off of total spending, and the real balance for the economy is productivity. The more productivity you have, because the way the economies grow are 3 things: demographics, how many people are in the economy. The bigger your population growth, the faster your population growth, right? Like who is it that's growing the fastest right now? India is supposed to surpass China in the future, and the UK and Germany and us going forward. I think China is up there, and then it's India. So India has a fast growing population. That's going to increase your productivity, your buying power, right? All that stuff. So productivity is basically how much product you're supplying, how much can you produce for the world, how much production and supply you can give, right? That also is a big factor for the economy. The higher the productivity, the higher your economy can grow, because you can now pay off your debts, okay? The other way the economy grows is debt growth, which we already talked about. The U.S. Treasury, they create debt to spend it. And everybody thinks debt is bad, but it's not really bad unless the debt is going towards the liabilities. So if the U.S. government is spending on relief or checks to people, that doesn't really produce jobs, right? So you want the U.S. government to spend more or create debt to create more jobs, to create more productivity, to pay off the debt. But if you're just giving people checks to spend, then you have excess demand, you have more debt without any productivity. Therefore, inflation goes up, okay? So that's that debt creation. And then the other way is AI, or I'm sorry, AI is technology. Technology is the strongest productivity driver for the economy, which is you have Apple, Amazon, Google, Facebook, Tesla, the biggest companies on earth. Look at how many of you guys purchase on on or buy the what is it, the Instagram market or whatever, Instagram, the Facebook marketplace. People, Instagram or Facebook in general, Meta, they created a market. Amazon has a retail market, so they're meeting buyers and sellers at a cheaper rate, faster, and producing more GDP for the world, right? Also, Amazon and Walmart have the highest. They employ the most employees, so technology also creates productivity. It's important. That's why those companies are moving the highest. If Tesla does what they do, now you're going to create more vehicles at a cheaper price. Therefore, people can travel, they can go to work. There's going to be less wrecks because, electric vehicle, not less wrecks, I'm sorry. There's going to be less spending from consumers' wallets if this energy stuff works, because electric vehicles are cheaper, because if you can get the solar energy from the sun to power your vehicle at a tenth of the cost of gasoline, now you're paying less. Now you can spend more in the economy, or you can create a business. So that's how the economy works: debt growth, population growth, and productivity via technology. I mean, there's so many ways to gauge the economy too. Like, you can look at manufacturing, you can look at services. 70% of the economy is services. The other 30% is kind of manufacturing, which is like goods and industrial production, planes, vehicles, buildings, weapons. That's manufacturing. Services is like, I'm gonna go get my nails done. Um, I'm gonna travel. I'm gonna buy Netflix. Those are services. That's most of the economy. So that's what's holding up the economy today, is actually services right now. Hopefully that answered your question. All right, so yeah, so here we go. Let's go into the daily chart, or I'm sorry, the intraday charts here. See what's going on. And I'm going to throw this back on. Let's go to the 30-minute chart. I actually like to take a look at the 30-minute chart to gauge the trend. We could be getting the Qs bottom out here. Okay, looks like the Qs could be bottoming out. So I'm going to take the RSI. We don't really need to see the RSI at this point. We don't really need to see volume. We're just looking at price action. Okay, we are just looking at price action here. And it looks like you see this pattern right here. This is actually, let's take this off. Let's take this off. There's so many ways to look at it. Let's remove the pre-market action. I don't really care about the pre-market action. That's not important unless you're trading intraday. That's when it matters most. So we're going to go with this gap strategy. Take the gaps off. All right, here we go. So the Qs may be bottoming. And the question is, will the Qs bottom? And the reason I say that is because here's the downtrend we're looking at, right? We're holding higher from yesterday. Yeah, we're holding higher from yesterday. We did gap down, but we're still holding higher. So in the short term, the Qs double bottomed here at 364. Now they're holding higher, but we are at the trend, so we could just reverse and go back down, make a new low, or we could break out of this trend, right? We could break out of this trend. So we'll see how that actually comes in. But right now, the Qs could be bottoming, and the catalyst for the Qs bottoming would be that bond yields peaked out. Oh my goodness, they keep climbing. Hopefully they peaked out. Bond yields peaked out, right? The interest rates to equities for the market, if those peaked out, that's a good thing. That means the dollar can start to roll over and fuel equity prices higher, and also global trade. So you want the dollar to roll over. And I think that's what the market is trying to sniff out. Is the dollar going to roll over because yields are coming down, because inflation expectations are down? Is it going to roll over? And that's what we're looking at here for the Qs. Now, IWM, small caps, these are a little more risky, a riskier, not risky, but they call it risk because it's more risk, but it's basically smaller companies who haven't earned, they're not really profitable yet, but that's where the fastest growth is. So IWM or the Russell 2000 ETF is a representation of high growth companies. High growth, but they're not profitable yet, so they're a little more risky, but they grow a lot faster, right? They grow a lot faster. Also in a downtrend, we're looking for the bottoming pattern here. No, it doesn't look like it's there yet. So that's IWM coming down. Let's look at the Dow. The Dow's been doing pretty good lately because the Dow has more companies that are defensive, I guess you could say, defensive in name, and they have dividends. And I know a lot of people are like, oh, I love dividends, but it's like, well, you know, dividends, you could get trapped in dividends because if the underlying collateral, which is the stock, is falling, like Verizon, but it pays a good dividend, well, you're losing out. Who cares if your dividend goes up if the underlying collateral is falling faster than your dividend can pay you out, right? So that's why high growth companies don't pay a dividend, because they're saying, hey, we can make the stock price grow faster, to compensate you, versus giving you a dividend. If we give you the dividend, we can't grow as fast. If we take it, we can grow faster. And then you could just sell our stock later when you feel like it's overbought, right? So here's the Dow. The Dow is holding in straight. This is why I think, hey, the market's fine. The Dow is holding up, and some of the big companies in the Dow are going to be Caterpillar. Let's take a look. These are bellwethers, I like to say, in the economy. So these individual stocks are going to give us a gauge on the global, not the global, but the U.S. economy, how it's doing. Caterpillar is wedging. It's still very strong. Nice relief rally. So, hey, Caterpillar looks like it's setting up for a breakout here. That's a nice little wedge there. So this is a proxy. Caterpillar is a proxy for construction building, right? Caterpillar are all the what do you call them? Tractors, all the new technology for tractors and tools for building infrastructure. So that's why the manufacturing sector, I think, is recovering, and GDP is starting to recover, because there's fiscal stimulus going into these names like Caterpillar, DE, Boeing, whatever it is. Let's see what Boeing looks like. Boeing is holding the highs, so Boeing looks pretty solid here. It's not bad. Okay. What about DE, Deere Company? Deere Company is not in a downtrend. It's holding. So some of these Dow companies are doing pretty well. I think Visa also. Let's see. Visa is one of those companies. Also, Visa's dipping into DeFi. So very bullish for DeFi crypto, because Visa, it's a mega cap company who is investing in DeFi. So Visa grinding higher here, right? A lot of good market breadth. Used to get the mixed castor oil, rosemary oil really works. Okay. Yeah. I got to try that out. As long as it's not toxic. I look at ingredients because I don't want to put toxic stuff in my skin. But okay. Appreciate I got a lot of patches in my beard. Look, got to fix those patches. Okay, so Qs are looking good. Let's take a look at the big mega caps here, because one of the arguments is that we need mega caps. Ooh, damn, I didn't even see that. Nvidia is recovering. That's a good sign. Nvidia earnings are coming up. Anybody know when Nvidia earnings are? While I do the technicals, Nvidia earnings are coming out soon, and who knows, maybe the market sells off after Nvidia's earnings, but hey, that's an upside catalyst. If Nvidia comes out pretty good, if they have better guidance, then that's going to be very good news for the market. I'm looking for guidance in Nvidia. Looking for guidance for Nvidia. So Nvidia bounced very hard. That's a good sign. Apple, where's Apple at? So this is mega cap tech, right? We need mega cap tech to recover. Oh, Apple at the lows, but it is forming a base. So Apple sold off. But it is forming a base at that prior support or prior resistance level. So it's forming a base down here. Okay, that's gonna suck in a lot of buyers for Apple. And I know people say, but Apple sales sucked. Bro, like, it already sold off though. So yeah, up here that price sucks. That's why it sold off. But now you get what are we down from Apple? We're down 10%, okay? 10%, which is like 300 billion. Bro, they lost more market cap than most companies are worth in the stock market. So don't expect it to keep falling. Apple has a lot of promise. They always will. It's the best company, or the biggest company in the market, okay? Microsoft, which is the enterprise software, dominant network for enterprise software. Microsoft is bottoming out. Clearly, yeah, Microsoft's bottoming out. So it's breaking that down pattern, and breaking that downtrend, and it's starting to move up. So that's a good sign. Amazon, I think Amazon is one of those names that has a lot of promise because it's been suppressed. Amazon, let's see what Amazon's doing. Had that gap up after earnings, holding on to the, it's kind of dropping into the gap. Maybe it finds support at the previous level. So Amazon, And this is just a proxy for the overall market. I still think Tesla is the best risk reward of these mega caps. It hasn't even got close to all-time highs. Plus, it's in that downward channel right now. So here you go for Amazon, 137 support, right? That's good. It's holding on there. Google. See what Google looks like. DXY don't show any sign of recovery. It's still bullish. I don't see US 30 coming back. DXY shows, yeah, DXY is still in a downtrend. I think it's just going to take a little bit of time before DXY starts to roll over again. But it is at the top of the channel. It's nearing oversold. I give it a week. I'd give the dollar maybe next week where it starts to roll over. What is a big event? That's what we need to keep track of. By the way, this is Google. Google also consolidating. Okay, so mega cap tech. Mark my words. It looks like mega cap tech, the FANG or whatever, is getting ready for another move higher. That's what I see. I see another move higher in mega cap tech. It's sold off the most since the peak of the rally. Okay, there you go. Netflix is holding on there. Who else do we have? AMD. You could argue AMD's in mega cap tech. I mean, part of the Magnificent 8, 9, whatever. Still big consolidation here on AMD. Everybody keeps trying to catch these breakouts, but at this point, you really just got to hold on for dear life on AMD. You got to buy those lows and just hold. It's not breaking out. It's just not breaking out. And then again, looking at all these names, and look at Tesla just pulling back. So if you get mega cap tech bottom here, oh, nice bottoming at what, 233. So Tesla might be getting back above VWAP. I'm gonna check that out actually. If it does hold VWAP, that'll be a good sign. If Tesla can hold VWAP, let's load the trader. I didn't really want to go in the trader yet, but I think we did look at all mega cap, right? We looked at all the mega cap tech. Yeah, let's go into the trader. Let's see what this looks like. Oh, not still below VWAP, still well below VWAP, but Tesla bottoming at 232. Hey, that 221 level will look really good if we can get down there. We have about 15 more minutes. Throw your questions in. I'm going to hit the restroom real quick and then throw your questions in. We'll do a little review on the significance of the day. What is the significance of today's price action in the macro, the technicals, China, the US? What does that mean going forward? We'll be right back. All right, we are back. We are back. Not gone too long. Also, let's check this the market internals. I like to call these market internals. This is advanced decline. Ooh, it fell. Okay, market breadth is falling. Market breadth is weak. This is not a good sign for the S&P. It means more stocks are now under the 50%. So this is bearish because 47% of stocks in the S&P 500, but it is at the bottom. It could be bouncing here. 47% of the stocks in the S&P 500 are below the 50-day moving average. Yes, the S&P is at the 50-day moving average of line of support, but there are more stocks in the S&P below that 50-day. So that's a decline. But here's the positive. We could be bouncing. We could be oversold. The last time we got oversold in the RSI, which is why I love using RSI, the last time we got oversold, which we are deeply oversold, this was the bottom for the 50. This was the bottom for how do I phrase this? This was the bottom or the reversal for stocks to get back above their 50, for more stocks to get back above their 50-day moving average. Okay. So this is market internals, and we just want to look at, vast majority of data to see what's happening here. So it's funny that this is a sharper sell-off for stocks moving below their 50 than the last one, than the last sell-off. Even though we're still 48%, that tells me that yes, some stocks are declining, but a lot more are holding higher than they were previously when there was less pressure to the downside. Okay, now this is the 100 stock. How many stocks are moving above the 100 moving average? We have 58%. So we're still above 50%. So more than half are above their 100, and then 56% above their 200 moving average. Advanced decline for today, which is how many stocks are advancing versus declining. Very negative territory, 1,700. Volume is volume is terrible today. Volumes have been falling for a while. This is how much volume is advancing versus declining. Very sharp downside, or withdrawal of liquidity or of volume in the market. So there's not a whole lot of volume in the market, which could mark a bottom here, right? Usually if you get accelerated volume and you're making a sharp move lower, then that's a big risk off signal. But if volume is declining and the S&P can't move lower, the sellers are kind of running out, right? They're running out of breath, or they may be exhausted a bit. Maybe I'm wrong, but that's how I look at it. I still think we might have a gap down. We might possibly have a gap down. And let's look at that forward-looking data. What are we going to see tomorrow that tells us whether we gap down or gap up? What do we have coming in the pipeline for tomorrow's data? Tomorrow is already Wednesday. Wow, it goes by quick. Oh, hey, we get the UK. We get the European growth rate, GDP growth rate tomorrow. That's going to be interesting. Can they start to recover in growth? Tomorrow we get housing market data. I think it's going to come in pretty weak. It seems like the housing market recovery is stalling right now. Okay, the housing market recovery stalling, which is a factor against economic growth, but it is a factor for the Fed's dovishness. So it's a factor for the Fed to stop hiking. Okay, building permits, those have been negative. We'll see how building permits come out. So tomorrow's all industrial production. So we talked about that productivity factor in the economy. If that keeps moving negative, it was negative last month for the first time during this whole cycle. I think the last time the industrial production was actually negative was the pandemic. Yes, it was the pandemic. So if that's the case, that's, if the housing market is stalling here and industrial production actually keeps going negative, that's actually going to push the Fed to pause and start talking about cutting. Okay, start talking about cutting at some point. They are trying to say they won't cut till the middle of next year, but again, if inflation makes enough progress, I believe they will cut this year, and I think that progress is at 2.5%. Mark my words. Call me out if I'm wrong. If CPI gets to 2.5%, it's very possible the Fed can cut rates. Now, what I'm not sure about is if that includes the core inflation rate. Okay, core is dropping a lot slower, but the one factor to that is shelter prices, right? They're using owner's equivalent rent as a measurement, which is stupid. Nobody fake rents out their house. Owner's equivalent rent is keeping shelter CPI higher, and that's basically how much would you rent your house out if you didn't own it? It's stupid. It's dumb. I think it's dumb. I think it makes no sense. If we look at the real data for housing inflation, it's falling like a rock. So again, who knows? I don't know everything. We're just going to keep track of it and look at how the bond market moves. So tomorrow's all housing data. I don't really see a whole lot happening until 12/1. What is that going to be? 1 p.m. Eastern time. We do get the Fed FOMC minutes. That's going to be big. So I think the market right now is trying to front run or guess, are the FOMC minutes going to be positive or negative, more hawkish or more dovish? That's what we're looking for tomorrow. And when they do release those minutes, I may be live actually on here. Maybe I'll come in. This is going to be 11. Now this time is different because I'm on a different time scale here. My computer says 12:15. It's really 1:15, so that's 12. Yes, actually, I'll be live for this. I'll be live for the FOMC minutes. We'll go through the FOMC minutes and see if what the Fed is actually saying. This is basically um, their statements from the last meeting, and sometimes they revise their statements and they say, okay, we're actually think that the economy is stronger than we expected. Oh, inflation is making more progress. So we'll go through that live tomorrow, the FOMC minutes, along with the housing market data. I expect it to be pretty weak. I do expect it to be pretty weak. Okay. So let's see, what else do we have here? Any tweets, any new tweets, any new notifications? I don't really think so. Just double checking here before we get going. If you guys have any questions, let me know in the comments. Don't forget to sign up for the newsletter. If you're new, come out with a newsletter every single week. Last week's newsletter was all about inflation, making progress, a lot of progress on inflation. A lot of progress on inflation. Why does this chart keep falling? Okay. Any more technicals? I am still holding Zoom. I'm going to do some technicals on Zoom right now. These are leap calls, though. I'm looking at 2025, so I could wait it out and even break even if the market goes up. But Zoom does have earnings in about a week and a half, so I'm kind of betting on Zoom earnings. But this is not a day trade. I'm not looking at Zoom over the next couple of weeks. I'm actually looking a year in advance. I think they're going to come out with some AI stuff here. So Zoom looks pretty good. It's showing some, I guess that is bearish divergence. Price is climbing, but the RSI is still flat. So that's kind of bearish divergence there for Zoom. Earnings coming up pretty soon here. A lot of upside though. I still think there's a lot of upside for Zoom. I think that Zoom is one of the names that is going to be is still very dominant, but because of the previous report, because people are coming back to work, it really crushed their growth expectations, and so I think the downside is already priced in. I think the downside of Zoom is priced in. I think there's only upside from here. That is my bet. I could be wrong. I just think that's the bet I'm going to take here for Zoom. See Zoom. Also, you have Teladoc. That's the other one I'm holding. Just a small position. Came all the way back to the lows, unfortunately. But there's a lot of buyers down here on Teladoc. All right, there's a lot of buyers down here in Teladoc. You know what? Let's go to market breadth really quick. Let's switch over to the S&P sectors. I want to see maybe NVIDIA. We did go over NVIDIA. We went over NVIDIA. NVIDIA is recovering pretty nicely. Earnings come in, 23rd? So NVIDIA had a nice bounce here. If anything, I think NVIDIA will, after earnings, could come back to 380. It could come back to 380 or just explode to all-time highs. You just don't know with NVIDIA. So what I'm going to do is I'm going to take a look at, I'm going to switch the charts over to, because we're about hitting our time. I'm going to switch our charts over to market breadth. Which is, how much of the rally is are we seeing any strength coming into this rally? All right, here we go. IWM still holding. Looks like it needs a pullback. S&P equal weight. This is the weekly chart. Let's go to that daily chart. S&P equal weight is grinding up, still grinding higher. Maybe it loses support here. It is below that 50-day moving average. So equal weight is starting to barf a little bit. It's going to come down to those FOMC minutes. They're becoming more and more important. Industrials, weak today. I'm guessing most sectors are weak. Healthcare still pretty strong. Okay, healthcare held up today. So industrials weak, healthcare strong. Utilities very weak. Consumer discretionary weak today. Consumer staples, defensive stocks weak today. Communications were weak today, but not too bad. Financials got crushed. That makes me want to look at KRE. Financials got crushed today, and the financials are getting crushed because of the Moody's down or the Moody's downgrade on like 12 banks. So there's a downgrade on Moody's, and it's that interest rate risk. It's the U.S. Treasury bonds selling off. The collateral is falling, therefore it hurts their lending power, and that's how they make money is by lending. But if they can't lend as much because their collateral is down, like obviously, if you have $1 and you can lend out 10, but now you have 50 cents, you can only lend out 5, right? So that's why they're getting downgraded. It's simply bond yields, which is why we always look at bond yields when we come in here. Our bond yield's going to ease here. Well, the Fed signal, the FOMC signal a pause so that the confidence in the banking sector can ease. I think the Fed's FOMC minutes tomorrow are going to be dovish, more dovish than people think. Okay, so anyways, I didn't look at this. XLE, wow, energy's down today. Okay, energy's, well, duh, oil price is down. Okay, ITB, this is a home builder. Whoa, this is positive. Home builder construction up today. Okay, so home builders are still, because they basically have an incentive to keep building for apartments, not single family homes, but apartments. So apartments, multifamily, that's what's really recovering here in the housing market, not single family homes, but apartments. So those prices will come down. I expect a massive demographic shift over the next probably 3 years into apartments versus housing versus houses with mortgages. Okay. SMH, oh, pretty bearish. So semiconductors, looks like the trade's not going anywhere. KRE, regional banks, a lot of risk because those rates are up. But as we said before, this reminds me of this hot spot right here. Last time regional banks had risk and they fell because of this interest rates. That's when we saw the Fed's balance sheet start to pick up again. Now, I'm going to say this, okay? The more risky things get in the bond market, okay? The more risky things get in the bond market, the more I'm expecting this right here, this Fed balance sheet. Okay, this thing has matched the S&P, not matched the S&P. Well, yeah, it has matched the S&P 1-for-1 over the long term, but this Fed balance sheet here is, you see how it spiked during the banking crisis? Well, I'm looking for another banking crisis to happen, right? I don't think it's going to I'm not saying the probability is really high. I'm just saying if it does, well, what do you think is going to happen? We're going to get the Fed's balance sheet pump again. That's what I expect. I could be wrong. I just think the probability is very high that the Fed will have to step in again because the U.S. Treasury is draining liquidity as they unload these U.S. Treasuries. I also expect more fiscal policy from Joe Biden. He's going to keep printing at the end of the year because he wants to get his ratings up. He doesn't want to look bad. And obviously, if people remember, oh, I remember when Biden gave us those relief checks, right? So any thoughts on taking a position? He got beat up bad. Any thoughts on taking a position? I don't know what you mean by he got beat up bad unless you're talking about Biden. Any thoughts on taking a position? Tesla. Right now, I'm looking at Tesla, sharp moving. I'm looking at options, not really shares. I'm looking at options for Tesla at 235 to 221. That's what I'm looking at here. So yeah, KRE, that liquidity from the Fed. Also, I'm looking at this liquidity also. This is money market fund liquidity. And I always try to figure out, how do I explain this in a simple way? Okay, how do I explain this in a simple way? And let's get this line a little thinner. It's a little too thick. Here we go. This is the Fed's, this is liquidity or cash money. Let's just call it money. This is money at the Federal Reserve. It was going into their account. So as this line comes down, this means leaving markets, right? Liquidity or cash leaving the market, going into the Fed. Why did it go into the Fed? Because it gets paid an interest rate. It gets paid, whatever the Fed's interest rates are, you're going to get paid on that cash. So people are parking their money in the Fed. But it happened to bottom in January. It happened to bottom in January because liquidity came into capital markets. So that money started chasing the market because the market's going to give you a better return. S&P's up 20% from January, which is way better than 5% on your cash, right? So that cash started getting reinvested into the market. But now that the Fed increased rates again, well, now you're getting more you're getting a little more yield on your cash parked at money market funds, aka Fed facility, and you're getting a little more cash there. Plus, people are starting to believe that the recession is going to hit, and so stocks are going to fall, right? So I'm looking at this liquidity because basically, if the U.S. Treasury, I don't know how this is going to work. I really don't. I really don't know how it's going to work. But what we do know is if the Fed's liquidity facility, if well, not the Fed, if the U.S. Treasury starts to unload more short-term rates and to attract this liquidity, right? Then this thing shoots up, market goes higher. Period. Okay. Period. Market goes higher. That's more liquidity. It's leaving this is $2 trillion leaving the market from the Fed and going back into capital markets, going back into the banking sector. I just don't know how it happens yet. It could be, the Fed signaling we're going to cut rates. If they do signal in the FOMC that we're closer to cutting rates, people want to front run this. They don't want to hold their cash at the Fed. They're going to want to say, okay, let's buy the S&P, let's buy the Nasdaq, let's get into risk because the Fed is going to cut rates. So we're going to get less yield here. So let's get our cash into stocks. Let's get our cash into maybe bonds. Let's get our cash somewhere else. And then here comes capital, right? So I'm looking at this right here, this money market fund reverse repo liquidity to come back into the market. And then global net liquidity just made a new low. That sucks because you need that global liquidity to support markets. It's been supporting markets for the longest, but that may not be the case anymore. So it has an inverse relationship to the dollar. So an easy way to look at it is if, the dollar's trying to catch a bid too right now. So if the dollar can get rejected here, then maybe this global liquidity starts to come back up. And this is all the central banks. So it comes down to China. Is China going to print? If China prints, if they start printing again to save their economy and cutting rates, the dollar, I don't know, that might actually push the dollar higher. But unless people start investing, because it's really complicated. Either way, they've had an inverse relationship. So if liquidity does pick up, maybe the dollar comes down. And I think that's all we have. If you guys don't have any other questions, crypto market selling off. Is it selling off right now? Small little slip. Maybe there was some breaking news in the market. See if there's any breaking news here. Zero Hedge always has some stuff. Bearish positioning. We didn't even look at this. Bearish positioning. See what he's saying here. Oh, this is an article. We'll just look at the front. Bearish positioning no longer a tailwind. Fund manager survey finds that Wall Street least bearish since February of 2022. So Wall Street is no longer bearish. They're starting to get bullish. And that does sound like, we'll do the opposite of Wall Street. The only difference I think is we're coming out of a bear market and the macro is improving, not worsening. In 2022, the macro was getting worse. So if you got bullish in 2022 with bad macro, well, you're in trouble. This time around, the macro is getting better. Inflation is coming down, not going up. That's the difference. So I think this is not a bad sign in my view. He is a ticker symbol. Oh, that's a ticker symbol. E? Okay, I never heard of that. Yeah, it looks like crypto is selling off a little bit. Did stocks just slip also? We might have just had the stock market also slip. Well, I'll tell you what. The dollar is bidding higher. That's going to push crypto down for sure. Whatever it is, I always like to look at the dollar because whatever it is, the dollar will price it in. Dollar moving higher, it's going to hurt risk assets in the moment. Are yields going up? No, yields are coming down. Okay, so maybe it's not too, something must be something else happening. Volatility, volatility shot up. So something hit the market. Let me double check over here before we go. See, SPY just sold off pretty sharp. Q sold off pretty sharp. IWM, that means Tesla must have finally had that. Tesla's probably going to gap down and maybe to that 222 level. Okay. So SPY is losing support. We'll check out the next support here. Let's see what's the risks here in the market. Well, this was earlier. I didn't even see this. Russia tests digital ruble in bid to bypass sanctions. Interesting. I have no clue why the market's selling off. Anybody else know? It could be the Fitch warning. Let me go to CNBC. CNBC usually has some kind of breaking news. Yeah, let's go to CNBC and see if there's some breaking news on CNBC. And I'll send out some tweets if I see anything. Follow me on Twitter. It just could be the Fitch warning. Fitch warns it may be forced to downgrade dozens of banks, including JP Morgan. I saw that earlier, so it just could be fear. Home builder sentiment drops, recession fears. I could smell it all over the place. No, I don't see anything new. I don't see anything new here. Hindenburg said, Hindenburg, that is that research company, says 4.6 billion Kazakh, I don't even know what that means. Fintech is helping Russians evade sanctions. Okay. Traditional TV usage drops below 50%, first time ever. Yeah, nobody wants to watch TV. They're watching YouTube. Beware these stocks lurking in your portfolio. Get out of here. 40%. Oh, that's divorce. Couples say this was the number one conflict in their relationship. That's hilarious. Will Smith, the number one thing you can't build a successful career without. Bro, who's going to listen to Will Smith? He just got embarrassed. I can't say that word. I was going to say a word I can't say on here. Heads to Wisconsin. Yeah, I think it's the Fitch downgrade. I think people are pricing in the Fitch downgrade. You saw financials get smashed today. So we'll leave it with this. Let's see what it says. 46% of divorced couples say this was the number one conflict in their relationship, and it isn't money. Career choices, parenting differences, division of household labor, relationships with family, relationships with friends, finances, health choices, or you just didn't have genuine desire. Got pressured into it. All right, well, I think that's it. Market is selling off at the end of the day. About 30 minutes left. We'll be back on tomorrow. It's all about the FOMC tomorrow, FOMC minutes. What is the Fed going to signal to the markets? Will the S&P be able to hold the line or hold this 4,400 level? It looks like it is slipping the 4,400 level at the moment. We're on the wrong chart here. Okay, let's go to S&P. I think this is it right here. Come on, let's go. Yeah, so here we go. We're retesting that level. Alert. We are testing the, let's get rid of these SMAs. Looks like we're headed for 438, guys. Looks like we're headed for 438. Big pullback in the market. I still think it's a buying opportunity. I think it's a buying opportunity. Not like right now, but once we get the bottom, we're trying to hold 444. We're not holding it. It's not happening. Okay. Maybe we do get back up and then we hold it. We'll see. We'll track the technicals. But this was the level. Qs. Look at the Qs are still holding the level. So that's interesting. Tech is a little stronger than S&P today. So tech is actually showing some strength here. Dow, oh yeah, Dow's a little weak. IWM's pretty weak. So I don't know. I think the rotation back into tech is coming. Looks like there's a rotation back into tech. People might be FOMOing into tech. That might be the only strong sector. Interesting. Crypto's definitely weak too. And if the banks have issues with downgrades and collateral, that's going to hurt crypto because who do you think's, buying so much crypto all the time. It's going to be banks as they try to, front run the Bitcoin ETF and offer services on top of Bitcoin, Ethereum, and DeFi and all that. All right. If we have no more questions, I appreciate you guys coming on. Make sure you guys get your yes. Is Tesla and Netflix make up Nasdaq? Yes, Tesla and Netflix make up the Nasdaq. Tesla has a bigger part of the Nasdaq than Netflix, but yes, they're both in the Nasdaq, which is the tech ETF, the technology ETF. If you're new, Henzo, check out the newsletter. It's free. Link in the description. Check it out. I'm also streaming on YouTube if you want to replay kind of what we went over. Okay, so let's end it with the kind of what happened today. What was the review? So today we got some good news and some bad news. Fitch is down. Bad news. Fitch is possibly downgrades JP Morgan. This is all a result. Okay, actually, let me change this up here. This is all a result of. This is all coming from bond yields rising. Okay, bond yields is something you need to get familiar with if you're interested in the markets, how it works. The bond market is very important. The bond market is how you value stocks. It's how you value lending. Okay, if you're going to borrow a credit card, how mortgage rates, any kind of interest rates, they're all priced off the bond market. That's why the bond market is so important. And right now the bond market is selling off. The collateral in the bond market is selling off, okay? As it sells off, rates go higher. So higher rates mean less cash in the system, higher borrowing rates, slower growth. At the same time, it's going to hurt banks. As the collateral falls, banks can't lend as much. Also, they might have to hit the oops, I defaulted button, and that's the real risk. They might hit the default button. I don't think it's likely. Look, I know it's a fear. I don't think it's likely at all. I think the Fed will step in. I think they're fine. I think it's just more headline news. It doesn't mean it's going to happen. I really doubt it. But the market is trying to front run it and price it in. And that's the bad news right now, is that there's a lot of downgrades because 30-year mortgage rates are extremely high. The housing market is slowing down. We see that in the data. Go over the YouTube video so you can see it. Housing market data is starting to slow down now, okay, because rates are too high. The only thing that's actually going higher is apartment builds are going up, and those rental prices have probably come down. So that's the weakness we're seeing. Also, China is not as strong as we thought. Okay, but I don't think that's a bad thing for the stock market. I think it's a good thing because what it means is China will keep stimulating. As we saw, they just cut their 1-year loan rate. So China, and when I say liquidity, you hear it more cowbell, more liquidity. There's 3 liquidity factors. Fiscal liquidity. Okay, now people throw that word around, but I'm going to put it this way. I'm going to structure it like this. Fiscal liquidity, which is government spending. Government spending, okay? We're getting that in the U.S. a lot, so China could government spend, okay? Number 2, monetary stimulus, which would be the Fed printing more money, or the PBOC, the Central Bank of China, printing more money, devaluing their currency, creating debt, and pushing it out into the system to grow the economy. That's the number 2 liquidity factor. Are they doing that? They did it from October to January, but they slowed down a little bit, okay? But I think it comes back. Number 3 is cutting rates. When you cut rates, obviously you have more cash. If you're paying 25% on your credit card and all of a sudden they move it to 15%, well, now you have a little more cash, right? If you had to pay $200 a month because out of interest rates, and then your interest rates drop in half, you have $100 left of cash, extra cash, disposable income. That's more liquidity for you as a spender, right? Well, on a macro scale, on a big scale, if you cut rates a little bit, you're creating more liquidity in the market. So I expect China to keep cutting rates. They're already doing it. They're weakening. Their economy is not strong enough. And the U.S., we got the GDP revision up. This is more good news. The U.S. economy just got revised up by Atlanta Fed. So a region of the Federal Reserve, there's 12 members. They're in they have different jurisdictions in the U.S., but the Atlanta Fed, right, forecast for GDP is higher, which means the U.S. economy is not headed for recession. You need a black swan event, and we're not going to get it. If we did get a black swan event, guess what? The Fed steps in, just like they did in March when SVB and all the regional banks fell apart. So is there going to be volatility? Sure. That's why we watch the VIX. That's why we watch bond volatility. That's why we watch Nasdaq volatility to see, is the volatility really picking up? Are people really buying insurance against the S&P, against the stock market, against the bond market? If they're not buying insurance, it's obviously not a big risk. Okay. Biggest risk, keep this in mind. The biggest risk over the next 6 months is the price of oil. It's at 83.50. It's getting rejected here. Okay, it's getting rejected here at 83.50. It's starting to fall. Maybe it goes back up and retests 83.50. But as long as it comes down, CPI comes lower. And that's the real risk to the market this last 12 to 15 to 16 months. It's CPI risk. It is inflation risks. And inflation's been falling for 12 straight months. It fell and it finally bumped up because crude oil went up 20%. So if crude continues to fall or gets back down there, we're going to get a relief rally in all the markets. We're going to see a relief rally on the next CPI report because CPI, let's say it comes in at 2.9%. Now we're getting closer to the Fed's target. Now the Fed has to get a little more dovish. They're getting more optimistic about the economy and more dovish about policy, meaning they start stimulating, right? You're getting closer to the end of QT, or quantitative tightening, or in easy terms, the end of sucking cash out of the system and the beginning of easing the market, the beginning of easing the global, well, I guess it is the global economy, but easing markets, okay, by not hiking rates, by keeping rates still, and by giving more confidence for investors. There's still a lot of cash on the sideline. So big positive. I think China keeps stimulating. Oil prices have peaked. Well, hopefully they peaked, but right now they're getting rejected. So if we keep that up, lower oil prices, we just got to keep our eyes on bond yields. That's the issue. Bond yields are still going up, and that can cause some real risk. Both news are bad for stocks. I'm still looking one more low in the S&P. A lot of people are. We could get one more low in the S&P. We're going to keep track of that. Anyways, I'm out of here. Appreciate you guys. Don't forget to subscribe, like the video. I'm trying to get the subscribers up here on YouTube. Anyways, keep showing up. Free newsletter. Stay blessed. Make sure you get your exercise. Eat healthy today. Be the best you possibly can be. And stay blessed no matter what. You guys stay blessed. I'll catch you tomorrow morning for the FOMC minutes and the technicals and the macro. Take it easy.